everyone, I'm Kathy Lee with BK Traders. November will be another busy month for the financial markets, and it is important to be prepared. In last month's October Trading Tips video, I talked about how October is the most volatile month of the year for stocks. And volatility did pick up, but due to something none of us could have predicted, which is the attack on Israel. In October, we also saw stocks fall to 5-month lows and gold rise to 5-month highs. The US dollar gained strength across the board, rising to 1-year highs against the Japanese yen and year-to-date highs against the Canadian, Australian, and New Zealand dollars. Every day, we see how fundamentals matter, how the big stories, big macro stories, impact the financial markets. And now, more than ever, you need to be aware of the seasonal patterns, upcoming event risks, and have your eyes on the headlines. As we kick off the month of November, here are my top 6 trading tips. Number 1, as you can see in this table, November is the second most volatile month of the year. With the intensifying conflict in the Middle East and the greatest risk of World War III in decades, there are plenty of reasons for volatility to remain escalated and get even higher. So far, we haven't seen the panic in stocks, gold, or oil, but at any point in time, these assets could finally catch up to the severity of the geopolitical risks. As a trader or an investor, this means that you need to consider buying gold as a hedge, buying volatility, buying puts on the market. With that said, number 2, on a seasonal basis, November is actually a great month for stocks. This chart shows how November is historically the 3rd best month for the S&P 500. But take a look at the chart closely, and you'll see that hands down the best month for stocks is actually December, which is probably where we get the term Santa Claus rally. What this tells you as a trader or an investor is that if there's a steep sell-off due to geopolitical uncertainty or anything else, look at it as a buying opportunity because wars rarely have a lasting impact on the market. Number 3, a potential U.S. government shutdown also returns to focus this month. Last month, Congress passed a stopgap funding bill to keep the government funding open through November 17th. Now, if lawmakers fail to pass another spending bill or stopgap spending measure before that date, there will be a government shutdown. If that happens, Moody's could cut the U.S.'s sovereign debt rating and stocks would fall. However, the election of House Speaker Mike Johnson, the ongoing conflict in Israel, and other emerging geopolitical tensions like U.S. airstrikes in Syria makes a shutdown in the U.S. government less likely because that would also affect their military operations. Number 4, on a seasonal basis, November is actually historically the best performing month for dollar-yen. A lot of that hinges on what the Federal Reserve does, but minimally, we know that the Bank of Japan won't be stopping the yen slide, and they aren't raising interest rates aggressively or actively intervening to prevent the slide in the Japanese yen, which effectively means that they're greenlighting the dollar-yen rally. At some point, this could change because it can't go up forever, right? But for now, they've opened up the room for more yen weakness. Avoiding a government shutdown would be good for U.S. stocks and the U.S. dollar. Number 5. There are a number of central bank meetings this month, but there won't be any major policy changes. November kicks off with the Federal Reserve's monetary policy announcement, and the surge in bond yield pretty much does the central bank's job for them. The economy is strong, data has been good, but things are starting to soften with some weakness in the labor market and inflation. The rise in bond yields and the geopolitical uncertainty means that there's no way the central bank will risk raising interest rates right now. That's not really the question, right? The main question is whether the slowdown in job growth and softer inflationary pressures is enough for them to shut the door to tightening. I don't think the Federal Reserve is going to change much in their statement because of all this uncertainty. The Fed will most likely wait until December before making any significant policy changes to guidance, because that's also when they update their economic projections. There's no reason to rush on it now. Number 6, while there won't be any monetary tightening or monetary stimulus, watch for possible fiscal stimulus from the Chinese and the Japanese, which would be positive for the Chinese yuan, the Japanese yen, the Australian, and New Zealand dollars. I hope you found these tips valuable. Understanding fundamentals and incorporating them into your trading is very, very important. I personally use fundamentals to trade every day. If you want to learn more about how to incorporate fundamentals in your trading, check out the special discount link in the description below.